Carlos assumed additional responsibility and temporarily taken up the role of Chief Operating Officer till officer last year, and till we found a long-term replacement for Diego. With Mike now coming on board, Carlos will resume his original role as group strategy and continue to lead multiple projects under the Open Ag initiative, including post-harvest business, carbon, and digital projects. Moving on to our financial performance now, over the past quarter and 9 months, the entire sector had to deal with multiple challenges, including higher input costs, a sharp rise in freight, and intermittent logistics or supply chain issues. On the positive side, the demand has stayed strong, and we believe that these would stay strong for a while. I'm very happy to say the perseverance and untiring effort of the entire UPL team, we once again have been able to deliver a strong set of results, surpassing our guidance. During the quarter, the revenues grew by a robust 24% and EBITDA by 21%, which demonstrates the resilience and the quality of our business model. Our diversified global presence, in-house manufacturing of key APIs, effective supply chain management, and strong innovation rate results in the gradual transition to a high-margin, differentiated, and sustainable products, enabling such a strong performance, even in these inflationary markets. As announced last week, on the one of our associate companies in Brazil, Sinagro, which is engaged in distribution of agrochemicals and inputs, has recently brought on board Bunge as a strategic partner. Bunge will acquire 33% stake in Sinagro. Bunge is one of the global leaders in sourcing and processing and supplying of oilseeds and grain and ingredients. We will enable Sinagro to leverage the strong Bunge relationship with farmers, thereby accelerating its growth plans in Brazil. On our ongoing journey of reimagining sustainability, I'm happy to share that our efforts have once again been recognized, and UPL has ranked #1 agrochemical company amongst its peers on sustainability performance by Sustainalytics, second time in a row in its 2021 ESG ranking. We successfully completed the first leg of crop residue program covering 420,000 acres in North India through our digital platform Nurture. With a very strong, encouraging results, this pilot prevented 1 million tons of carbon dioxide emission from being released. We intend to expand this cover significantly to higher area next year and continue to invest on our digital platform. Finally, we look ahead to the fourth quarter. The demand for agrochemical continues to be healthy globally. We are confident of the this year on strong footing and already demonstrated and more than meeting our commitments. On that positive note, I will now hand over the floor to Carlos to take us through the business update and global operations. Over to you, Carlos.
Thank you, Jay, and good evening, everyone. The last 3 years have been truly special for me. We have been on an amazing journey, and I have been so proud to be part of it. Since the integration of Arysta exactly 3 years ago, we have transformed UPL into a purpose-led company through Open Ag and are now on the path to reimagine sustainability. In addition to deliver upon our financial commitments year after year, we have become the leader in sustainability amongst our peers with a customer-centric approach. In the last year, I assumed the responsibility of leading the global crop protection business, in addition to my original role of global COO strategy and innovation. As shared by Jay, after the end of the financial year 2022, I will refocus my full attention towards driving UPL Group's growth strategy, leading multiple strategic projects under OpenAg. This has been possible since we have been able to find an excellent candidate in Mike to lead the global crop protection market. We are truly excited to have Mike in our team. Mike brings deep industrial knowledge, a passion for environmental and economic sustainability, and extraordinary end-to-end expertise. We could not have been choosing a better person to drive our business forward in the next phase of our journey. I would like to once again extend a heartfelt welcome to Mike. I'm now pleased to share some highlights for the third quarter financial year 2022. We continue to operate in a highly volatile and uncertain world, which keeps challenging us in new ways every day. Whether these are in a form of supply chain or increasing input costs, we have been successful in providing solutions to address the pain points of farmers globally, while also delivering strong our financial commitments. We take immense pride in the agility of our team, the strong customer relationship, unique backward integration, and supply chain excellence. As part of our commitment to reimagine sustainability, we are excited about the recent announced collaboration of Sinagro with Bunge in Brazil, as highlighted by Jay. This partnership is expected to strengthen Sinagro's grain origination strategy to leverage complementary capacity of both companies. Some examples include the ability to strengthen fertilizer offers, improve risk management tools for barter, and become a preferred partner in sustainable, traceable, and certifiable production for farmers and end users. We would like to highlight some additional exciting news relating to our open collaboration approach. Firstly, through our partnership with Meiji and Mitsui, we have obtained our first registration in India of our flupirimine-based solution to address key pain points of rice farmers. Secondly, we continue our strong collaboration with Christian Hansen and are pleased to announce that we will start commercializing the first solution in India after the next few months. Furthermore, a registration has been applied in Brazil for a unique nematicide composed of 3 strains addressing significant pain points of farmers. Lastly, we have initiated the commercialization of the solution derived from blockbuster CTPR in multiple geographies as a result of our collaboration with FMC. Let's take a look, moving now to the financial results. I am pleased to report that our revenue, as well as our EBITDA for the quarter, have been shown very strong, robust growth. The revenue has grown by 24%, while EBITDA have increased by 21% versus Q3 financial year 2021. The growth in revenue was led by significant improved price realizations, coupled with a healthy volume increase. We have successfully achieved 43% gross margin, enabled by 13% price realization, largely offsetting the inflationary active ingredients and increased freight cost. We have maintained our EBITDA margin versus last year, despite lower contribution through optimization of our overheads. Our net working capital have improved to 108 days from 117 days versus last year. Additionally, our profit after tax have grown by 40% to 1.218 crores versus last year. Now, let's look at the performance of our regions in the Q3. In Latam, we achieved 22% growth, led by our herbicide portfolio, largely through improved price. Additionally, our insecticides and our NPP biosolutions offering have also contributed to the revenue increase in the region. Brazil and Argentina have shown strong growth, also driven by herbicide. Mexico have maintained its revenue versus previous years, despite the impact of drought followed by a hurricane causing high channel stocks. Other countries have also grown robustly over previous year. In North America, revenue grew by 57% this quarter as a result of a higher volume, as well as improved price realization, specifically due to upsides in herbicides. Further, improved commodity price, tight supply for key products, and favorable channel stocks enable a strong performance. In Europe, we grew by a robust 26% versus previous year. This strong performance have been achieved through a mix of favorable volume growth and higher price realization. Poland and DACH region have delivered strong growth, driven by robust performance in mainly herbicide. Growth in France have been led by a herbicide and supported by fungicide and NPP biosolutions. Italy grew through higher penetration of NPP biosolution versus previous year. We also like to add this significant growth in Europe have been achieved despite revenue loss due to product bans. In India, we have been able to maintain revenue versus previous years, despite several adverse weather conditions, which results in a high Kharif sales return, heavily rains post-monsoon, and the quarter led to decline in key target crops. The rest of the world delivered a 15% growth in revenue versus last year, despite the ongoing external challenges, including supply chain constraint. Southeast Asia, Australia, and New Zealand have growth through improved pricing, higher volume, and favorable product mix. Southern Africa have delivered strong results while still recovering from the warehouse disruption in July last year. Growth in China have been achieved through improved sales in the fungicide and insecticide categories. Japan revenues have been impacted by 10% depreciation of the Japanese yen and lower sales in our AG&S segment. As we anticipate in Q1, Q3 has been a very successful quarter for us. We will carry the momentum forward in Q4 and conclude our financial year with a strong performance that will outperform our guidance from a revenue and EBITDA growth perspective. Q4 performance will be supported by strong demand for our herbicide portfolio and our continued pricing actions. In addition, we expect an accelerated growth from our NPP biosolution and a continuous strong performance from our differentiated solutions. We are also confident that the success of our upcoming new product launch, including Evolution in Brazil, Triskel in India, Preview in North America, and CTPR-based solution in multiple countries. Before I hand over to our Global CFO, Anand, to provide more detail on our Q3 financial results, I would like to congratulate our team for their amazing resilience, dedication, and unfailing focus in delivering such a strong performance in this quarter, despite challenges on several fronts. Anand, please, can you take over now?
Carlos. Thanks and good day to everybody. I'll start by providing you with the key financial highlights for the third quarter and 9 months earnings, and then take you through the financials in details. I'm extremely pleased to say that we reported a strong all-round performance during the third quarter, achieving robust growth in both revenues as well as profitability. Such a strong performance amidst a disruptive supply chain and inflationary environment is a true testament to the company's resilient business model. The Q3 performance highlights are as follows. Talking specifically about our year-on-year performance for the key financial metrics in Q3, we ended the quarter with revenues of 11,297 crores, delivering a robust growth of 24%. This growth was driven by 13% increase in price realization and a healthy 11% rise in volumes. I must say here that the price realization growth this time has exceeded the volume growth, probably a first in many quarters. It was also encouraging to see the company firing on all cylinders. The differentiated and sustainable segment continues to grow at a strong pace than the post-patent segment, and we saw growth across most key geographies except India. Most importantly, improved realization enabled us to cover the sharp rise in input costs and keep our gross margins intact at around 43%. Notwithstanding the 120 basis point increase in freight charges, our gross margins would have been above last year. On the operating profitability front, we delivered a robust EBITDA growth of 21% on the back of higher contribution and improved operating efficiency, with our fixed overheads as a percentage of sales coming down by 100 basis points to 19% versus 20% in Q3 of last year. Our EBITDA margins for the quarter were stable vis-a-vis that of the last year at 24%. Further, we continue to make long-term investments in our digitization platform, and in Q3, the amount spent was 75 crores. We continue to reduce the interest costs, and Q3, the interest costs were lower by 61 crores. The FX impact in the finance costs saw a decline of 191 crores, while there was a corresponding increase in FX loss sitting in other income under the head of other income of profit and loss account at 215 crores, resulting in a net loss of 24 crores, which essentially is the cost of taking the hedges. Robust growth in EBITDA combined with lower finance costs helped to drive 41% increase in profit before tax at INR 1385 crores. On the tax front, and that's the income tax front, effective tax rate for the quarter was marginally higher at 12% as compared to 11% last year. As we have guided earlier, for the full year, we expect the tax rate to be lower and to be at the lower end of our guidance of 15 to 18%. Overall, the net profit for the quarter stood at 18% higher at 937 crores versus 793 crores in Q3 of last year. Further, Q3 had exceptional items of about 52 crores on account of costs associated with restructuring, litigation, and provisions for certain expenses relating to warehouse fire in South Africa. Moving on to 9 months performance, financial highlights were as follows. During our performance for the first 9 months of the year, we delivered a healthy revenue growth of 17% over that of the last year, led by 6% higher price realization and 11% increase in volumes. As stated earlier, the improved margins in Q3 enabled us to catch up on the 9 months margin, and we expect to end the full year with better contribution margin than that of last year. EBITDA for the first 9 months continued to be robust and grew by 15% over that of the previous year, while our EBITDA margins were flat at 22% in spite of the inflationary pressures on cost freight that was faced since the beginning of this year. We reduced the interest costs in 9 months by 116 crores. The FX impact in finance costs saw a decline of 103 crores, while there was a corresponding increase in FX loss, which was sitting in other income head of the P&L of 405 crores, resulting in a net impact of 302 crores. On the whole, during the first 9 months of the year, we saw a strong year-on-year expansion of 24% in the net profits, and we ended the net profit at 2,247 crores for the 9 months. Moving on to working capital. On working capital front, though the working capital went up in line with the sales, but we reduced our net working capital cycle by 9 days to 108 days as of December 2021, reflecting the efficiencies in managing working capital cycle. Inventories were higher by 3 days, receivables were lower by 7 days, and payables were higher by 5 days. We expect the net working capital days to be around 90 days by end of the financial year. On the cash flows and debt position, on the debt side, we continue to deleverage our balance sheet in line with our commitment. Our gross debt and net debt stood at 105 crores and 478 crores respectively. Our gross debt and net debt stood lower by 405 crores and 478 crores respectively at 27,433 crores and 23,768 crores as of December 2021. We remain confident of meeting our guidance and bringing down the net debt to EBITDA to below 2 times by end of Q4. In fact, I'm happy to share that in Jan 2022, we have prepaid gross debt of $125 million. That's approximately 940 crores. Overall, as Jai and Carlos alluded to earlier, we continue to be well placed on the demand front and are confident to end the financial year with robust growth, exceeding the earlier guidance. With this, we open the floor for question and answers. Back to you, Radhika.
Yeah. So there are questions on the chat now, and I'll sort of read out those questions, and this will be answered thereafter. The first question in the line is, can you please help us understand the debt repayment schedule and what is the quantum of the debt repayment UPL is planning to achieve during Q4?
So as you would have noticed, most of our debt are long-term debts, and we don't have any obligation to repay that until May of 2024. And but we will continue to repay the debt. And this year we are targeting around 350 to 400 million of debt repayment, of which, as I mentioned earlier, 125 million debt is repaid as of January 2022.
The next question is, were there disruptions in supply chain of a competitor that was the reason for market share gains of UPL in North America? How much of the supply chain disruption is still visible going into Q4? And can UPL's resilient supply chain continue to gain market share in Q4 as well?
Carlos, you?
Yes. See, we are really focused in the price realization and being able to manage the volatility, because the volatility will be there. Now we know that this 2021 and the 22, we believe that the volatility will be there, and what we have done to really be able to improve price in the level that we have will be consistent there, and we will be able to really manage that. In North America and South America, the price of the commodities are so strong, and the farmers are really capturing value from their crops, and that they will be willing to absorb this difference as we have had during the last months. I don't know, Jay, if you want to complement any point on that.
Yeah, I think basically UPL has a very integrated business model with a lot of the raw materials and finished product manufacturing in-house. That has helped us to continue to gain market share because there is a self-reliance in that as far as supply is concerned, and that has enabled us to gain market share across the board. And we've had less volatility on our supply chain costs increase than maybe some of our competitors.
Yeah.
As far as some of the challenges are concerned, we don't see any big supply chain concerns for Q4, except for the ocean freight, where things are still historically high, and getting the biggest challenge for the companies has been on getting spaces on the ship and the Hazchem containers. So that we have been able to, even these tough situations, for the first 9 months we had a fantastic growth. We have been able to garner a very large share of space on various lines, and that we are confident that even in Q4 we would be able to have that kind of growth. Supply chain concerns.
And the demonstration of that is, say, we grew 11% in volume and 13% in price. Say 11% in volume, demonstrating that we are gaining share, and we have been able to manage that in a very focused way.
Yeah.
The next question is, any upward revision in the revenue EBITDA forecast? How is the cost inflation expected to impact UPL? Can you also give details on your conversations with the rating agencies? And what has been the reason for the QOQ increase in receivables sold?
Carlos, you want to address the first two questions, and I will take care of the interactions with rating agency as well as the receivables sold.
Yes. I'd say we have been able to work with an amazing connection between supply and sales, and we have been able to connect very well the ability to pricing. Say we have developed a work where the team in the field are completely connected with what is happening in the market. Say that connection have gave us the possibility to really arrive where we are today, that we are able to manage this volatility, and as Jay mentioned, this back integration that we have give us the possibility to be completely update what is happening in the cost base, in the cost perspective. And the agility side of UPL give us the possibility to really connect that end to end. Say we have been able to strengthen our relationship with our customers even more in this momentum, because it's a situation that impacting everyone, and we have been able to use this relationship to manage that. So Anand, can you complement how we are working on that with the last question?
Sure. Thanks, Carlos. On the specific question on the engagement with the rating agencies, we continue to engage with the rating agencies, and as committed to them at the time of taking the acquisition loan on conclusion of acquisition of Arysta in 2019, we are on target to bring down our net debt to EBITDA to below 2 levels. And we share with them on a regular basis the performance as well as the cash flows of the company. So at this stage, we don't see any apprehensions from the rating agencies on our performance. In fact, we are already engaged with them on seeing if we can get a rating upgrade. As regards the receivable factoring, we have been engaging in this program of receivable factoring on non-recourse basis for the last at least a decade. And as we have shared in the past, this program is largely taken to de-risk the organization. That's the way we look at it. Of course, in the last 3 years, when we took on the loan for acquisition, it did help us to reduce our debt. But largely, this program has been undertaken in order to de-risk our business, as when we sell the receivables on a non-recourse basis to the banks, the credit evaluation of our customers or our receivables is done not only by us, that's the UPL credit team, but it's also done by the banks before they take it on their balance sheet. So it just gives us reassurance, and it's one of the ways of de-risking our business. We expect this year to have close to about $1.3 billion of receivable securitization being done by end of March 2022.
Is there any preponement of sales in North America, LATAM, or are these, say, one-off sales that have happened in North America, LATAM because of the other competitors not able to fulfill the demand due to supply chain issues?
When we see the demand for herbicide, we have many different factors. One of the factors, and these impact LATAM in North America in a big way. One of the factors is weed resistance. Say the shift in the weeds, the change in the types of the weeds in the fields are really transforming the demand. It's transforming what the farmer needs to manage their crops. And the second factor is that the glyphosate price have increased price by 4.5 times. Say these two factors together have came in the same time, and we have been able to read that, to understand that many years ago. Let's say when we choose the product line that we have today, have been chosen 5-7 years ago, and we were already looking for what could happen. And nowadays, it's not by coincidence that we are having the results that we are having, the possibility to supply, and some of our competitors are not able to do that, because we have read that much earlier, to be able to back integrate our production, to be able to be more independent in the supply chain side. Say our ability to serve the pain points of our customers coming from this ability to anticipate farmers' pain points.
Okay, thanks, Carlos. How much investment have you made in the digital platform so far? How much investment do we require, and how do we plan to monetize that?
Want me to go?
Yeah.
The digitization of the agriculture is an ongoing process. UPL has invested, I would say, about $50 million, give or take, on the digital platform. The interface of farmers with using digitization is the only way to go forward in the future. This also brings us really close to understand the farmers' challenges. UPL is moving away from being a product company to a solution provider, and this is a journey which will be continuously there. The business will generate its return So, as technology develops, this will be a continuous investment. Monetization, as we all know, that it's an exciting space for investment. As and when there is obviously a lot of interest in investment, because we believe that our platform is the world's largest platform in agtech. But we are continuously discussing and evaluating options. And as and when there is a good development, we would let the investment community know.
Thanks, Jay. Given the recent induction of Mike, acquisition in Indonesia, extending partnerships like Bungie, further to Chris Hansen in Q2, one gets a feeling that going forward, market access and distribution would garner precedence over creating manufacturing infrastructure. Is that the right inference?
Yes and no. UPL has overinvested relative to all our peers in manufacturing. This gives us a very strong supply chain platform and ability to manage costs and supply chain disruptions. We believe that we will continue to invest there. We will continue to partner. We have developed a lot of indigenous suppliers in India who are large companies now and on key strategic raw materials for UPL. We will continue to invest and continue to invest both ends as far as building a strong supply chain and access to the farmers and to our distributors.
Thanks, Jay. Southern Brazil is facing a lot of weather issues leading to yield losses. Northern Brazil also facing flooding, we hear. What will be the impact on Q4?
We are not seeing impact in Q4 because of that. What's happening is that there are hotspot areas in Brazil, Paraguay, and Argentina that is having this severe drought. But the farmers are able to harvest basically 50% of their yield at least. And that level of harvest will give them a possibility to at least break even, except some very specific region. And that is, it's compared to the rest of the Brazil, parts of Paraguay and parts of Argentina. Say we don't see impact in our Q4 because of that. And the other parts of the region are moving in a very good way. I'd say the results in the northern part of Brazil are exceptional. The yield is very, very high. Say we are expecting a very strong Q4, and in other parts of the world like North America, Europe, Asia, we are seeing a robust Q4 perspective too. So we don't see an impact for Q4.
What's the update on the FMC collaboration? When do we expect the first product rollout, and when are we expected to start supplying the AI to FMC?
Raj, would you like to answer?
Yeah, no. So our plant will go into operations towards end of Q4, and therefore Q1 we expect the supplies to start.
And maybe Carlos, you can update on. I think in some geographies we already launched.
Yes. We have already launched the product in different geographies like Brazil. That we are starting our sales now in January, and the perspective is excellent. And we have the first launches in standalone products, but we have many mixtures coming on, and very, very interesting perspective, because CTPR plus our solutions, actual solution like the Perito, Esperto, and other products have an exceptional combination together with our NPP solutions. Say we will offer a very broad portfolio, and we can solve the caterpillar problems, we can solve the bugs problems. We will have a completed product portfolio. This will be a very important addition to our portfolio in the next months. And we have several countries that will come step by step during the next months.
Thanks, Carlos. The expected net debt reduction from FY 2021, the value.
Yeah, about 350 to 400 million, as I shared with you, of which 125 million was paid in this, in this month.
Can you give some sense on exporters of agrochemicals from China? We believe they got impacted because of dual control in Q3, but how are things playing out now? And do you expect any fall in AI prices?
Yeah, so I mean, if you see, I mean, still there are some molecules which are still at a very, very elevated price levels. There has been some softening, but if you see commodities, I mean, whether it is coal or crude or solvents, they are still 2 times the 9 months back levels. So they, with a cautious optimism, I can say that we still see for next 2 quarters there's some softening, but largely some of the key intermediate and products from China would still be at a high level. It will not be back to 9 months back level. That's for sure.
Thanks, Raj. So the core interest on borrowings is down to INR 361 crore versus Q3 cost of 393 crore, down QoQ. Is it because of the low interest rates or the net reduction in the debt?
It's a combination of both. We have been reducing our debt. As you see, last year also we reduced our debt by close to about 500 million. This year, from beginning of the year till date, we have done 2 tranches of sustainability loan, which was actually, these loans were taken and we repaid with the money, the acquisition loan, and the loans were taken at about 35, anywhere between 25 to 35 basis point lower cost of borrowing. So it's a combination of both reduction of debt out of last year, at the same time, reduction in interest costs on the fresh loans taken, which were used to swap the acquisition loan.
So, can you let us know in how many countries have we deployed biosolutions?
We have deployed in the 138 countries that we are present with our sales force in the field. And we are now on the NPP perspective for every country and region. We are defining a special team that is working focused on that. And we have been able to really transform some of our products in a global blockbuster that was more localized, and now we are expanding that for all over the countries that we are present. And we answer a little bit about your question before about the importance of the go-to-market perspective. I'd say our go-to-market perspective, like this Sinagro approach, like the approach that we have in many other countries, to be closer to the farmer, is to really being able to demonstrate our technology, because our technology of NPP combined with our chemistry gives the sustainable solution, what we name ProNutiva. And we are applying ProNutiva approach all over these 138 countries that we are present in the field.
Thanks, Carlos. Could you elaborate on the 500 crore receivable of insurance claims in South Africa? What is the delay? When is it expected? And does the company have any forecast on the timing when this should be expected?
Well, we are engaging with the insurance company. We have filed the claims, and we expect probably we are working towards getting it by Q4 within this financial year. However, I cannot say with any certainty, but efforts are being made to recover, get the claims before the end of this year. Sorry, Anand, you want to add something?
The expected revenues from the new product launches in Q4 and the year coming, FY23.
I'd say we are really focused in transform our business in value-added, more and more differentiated portfolio and sustainable portfolio. Our goal to be 50-50% sustainable and differentiated 50%, and post-patent 50% by 2026 full year. It's going on. Potentially we will achieve that earlier than that. And the new launches that we are having now, it's giving us the possibility to grow disproportionately higher the differentiated products. See, most of our growth is coming from the differentiated products instead of our post-patent products, and our biosolution products is growing very well too. And another very important point is we have granted our patents related to the platform that we have developed. We have create MMX, and our patents have been granted during 2021, and we have many other patents applied for that platform. Our drive to really sell differentiated solutions is there, and we are combining the differentiated solution with our biosolution. That is giving us the possibility to really differentiate us in the open ag approach from the others. Now, to reimagine sustainability, selling that promotive approach. I don't know.
Thanks. Are we looking for more tie-ups with innovators like FMC? There has been a lot of disruption which has happened in the supply chain. So how are we evaluating the outsourcing opportunities?
The whole Open Ag platform is about open collaboration. As we go further towards a solution-based approach, we believe that collaboration is the right way forward because we are moving away from a products company to a solution company, and we will provide the best solutions to our farmers across the world. So that's a continuous process. Today we have more than 70 projects under evaluation with different organizations.
Okay. And there's a question on the capex guidance for the coming year.
We'll spend about this year we had budgeted for about $330 million. I think we'll be lower. Our spend would be lower than that, and we will continue in that range, about $300 to $325 million. This is both capex for tangible, that's setting up manufacturing capacities, as well as for product registration.
Can you provide the contribution of price increase in glufosinate to the overall gross margins during the quarter? That won't really be possible to do it for one of the products. I think some of the people could not hear the factoring number is what.
Repeat it just.
Yeah. So the factoring number. Yeah.
I can repeat the factoring number. We ended this year, as of December, the total factoring that we have done is in $1 million, it's about $945 million. In rupees, it's about 7,175 crores. As against this, last year, December, we did factoring of 4,570 crores. In $1 million, it was roughly about $625 million.
Thanks. Thank you. How are the channel inventories across various geographies? Can this be an overhang for FY23?
Carlos?
Please, can you repeat, Radhika, the question? Sorry.
Yeah, sure. So it's how are the channel inventories across various geographies? Can this be an overhang for FY23?
I'd say the channel inventory this year is one of one of the lowest in most of the geographies because of this disruption that have happened. Mainly in herbicide, the inventory is quite low, except on this situation where you have this severe drought that potentially the market will face some inventory. And this southern corn, south corn region like Argentina, Paraguay, a little bit south of Brazil. In the overall market globally, the inventory at the end of the year will be very, very much below than last year.
So I think we'll take one last question. It seems that the Q3 actually had an inflow of working capital, which is remarkable given it's normally a high working capital usage quarter. Can you please explain? And do you still expect, as usual, a large working capital release in the fourth quarter?
Talking about the fourth quarter, certainly we expect a release of working capital, as has been the case over the last few years. That's been the trend. And I think, as I mentioned in my earlier comments, we are bringing in a lot of efficiencies in working capital management. There has been focus on reducing inventories. There has been focus on collections, especially the overdues. Almost at every monthly management review, leadership spends time on what is the status of overdue collections. So with this increased focus, as well as on the payable side, we keep pushing our vendors to give us longer credit terms. As we are one of their larger customers, we keep pushing for getting better terms. So this focus on working capital continues, and we will continue to do this as we move forward. So that's something which is ongoing. We have taken also several projects on what we call as SNOP projects, which are of planning and demand planning and distribution of products. So some of these projects also helps us to keep bring in more efficiencies in our working capital. Raj, you want to add something here?
No.
On the inventory side?
No, that's
okay. Thanks.
So that was the last question. Any closing remarks from yourself?
Oh, thanks everybody for joining us on this call. And in case you have any further questions, you can reach out to Radhika or myself, Anand Vora, and we'll be happy to answer the questions. Thank you once again for joining.
you.